Hey everyone, welcome back to Corporate Decoder, the place where we decode those dense corporate filings to see who is really winning and who is just making noise. Today we've got a big one from Repare Therapeutics Incorporated, and let's just say there is a surprise acquisition and some interesting payouts on the horizon. So what is the big news? Repare Therapeutics Incorporated is being bought out. Yep, a company that develops treatments for cancer has entered into what they call an arrangement agreement. This means they're all set to be acquired by Xeno Therapeutics Incorporated. It sounds like a friendly takeover, with Xeno Acquisition Corporation, a subsidiary of Xeno Therapeutics, buying up all the common shares of Repare. Now, this isn't just a simple cash and carry deal. The big takeaway here is how shareholders will be compensated. They're going to get cash for their shares, and that cash amount will depend on how much money Repare has in the bank right before the deal closes, after paying off some debts and fees. But here is the kicker, and where it gets really interesting. Shareholders will also get what is called a contingent value right, or CVR. Think of it like a performance bonus you get later based on certain future successes. The folks running the show at Repare, specifically a special committee made up of independent directors, have looked at this deal very carefully. They've talked to their financial advisors, and after all that, they've decided this arrangement is actually fair to the shareholders and good for the company. The entire board has also given it their unanimous approval, and they're recommending that shareholders vote yes. How will this all happen? It is going down as a court-approved plan of arrangement under Canadian law, specifically in Quebec. This means shareholders have to give it the green light, and it is not a simple majority. They'll need at least 2/3 of the votes cast, plus a majority of votes from shareholders who aren't considered interested parties. It is a way to make sure the deal is truly supported by the majority of the regular investors. Plus, there are other usual conditions to wrap up, like getting court okay and making sure everything stated in the agreement holds true. The agreement itself outlines all the promises made between Repare and Xeno. It is pretty standard for deals like this, covering what each side is responsible for. Xoma Royalty Corporation is also involved, basically guaranteeing that Xeno and its subsidiary will do what they promised. Now, while this deal is cooking, Repare is basically off limits for other buyers. They've agreed not to shop themselves around or entertain offers from other companies, unless a truly exceptional offer comes along that is significantly better for the shareholders. This is pretty standard to keep the current deal on track. If things go south, or if Repare decides to jump to another offer that's deemed superior to raise a breakup fee. In this case, Repare would have to pay $2 million. It is a way to compensate the buyer for their time and effort if the deal doesn't go through due to Repare's actions. It is not just common shareholders who are getting in on this. Employees and others who hold restricted stock units or stock options in Repare will also get their cash payout and those special CVRs. Everyone who has a stake is covered. Let's dive deeper into these CVRs because that is where the real long-term upside for shareholders might be. These contingent value rights are basically a promise for future payouts based on how well Repare's existing research programs and assets perform. First off, shareholders will get 100% of any extra money that Repare collects within 90 days after the deal is done. This is for things that were already in the works and finally get paid out. Then there is the big one, partnerships with major players like Bristol Myers Squibb, Debiopharm, Pharm, and DCX Biotherapeutics. This is a really significant part of the CVR. Shareholders get a big chunk of the money from these partnerships, and that percentage is quite high at the start. They'll get 90% of the net proceeds in the first 2 years. Then it drops a bit to 85% for the next 2 years, then 80%, and finally 75% for the remaining duration up to 10 years. This shows that Xeno believes these partnerships hold substantial future value. They also get 100% of proceeds from licensing or selling off specific product candidates like RP-1664 and RP-3500, and any other research programs if deals for those were already in the works before the acquisition. This is essentially giving shareholders the benefit of deals that were already lined up. Similarly, for their POG program and RP-3467, if negotiations started before this deal closed, shareholders get 100% of the proceeds from any future licensing or sale. And finally, for any new licensing or sales of product candidates and intellectual property that happen after the deal closes, shareholders get 50% of the net proceeds for up to 10 years. This means Xeno is taking on the risk and effort of developing these further, but Repare shareholders still get a large upside if these new endeavors are successful. It is important to note that these CVRs are like a special ticket to future payments. They can't be easily traded or sold, and they don't represent any ownership in Xeno itself. No interest will be paid on these CVRs either. It is purely about getting a share of future success. To make sure this all goes smoothly, Xeno has also entered into voting and support agreements with Repare's officers and directors. This essentially locks in their votes. They've agreed to vote their shares in favour of the acquisition and to help make it happen. These agreements will end once the deal is finalised. The shares controlled by these insiders represent a very small fraction, about 0.25% of the total shares, so it is more about showing commitment than swaying the vote. Now, before we wrap up, let's chat about what this all means. Repare Therapeutics was focused on developing new cancer treatments. Being acquired by Therapeutics signals a few things. First, it means the market or potential acquirers see value in Repare's pipeline, even if it hasn't yet translated into massive profits. The significant payout structure, especially the CVR, is tied to future partnership performance and product sales. Strongly suggests that Zeno believes Repare's existing pipeline and ongoing research have a very high probability of generating substantial future revenue. The structure of the CVRs is particularly telling. The declining but still high percentages over 10 years for existing partnerships implies Zeno anticipates continued success from these collaborations. And they're sharing that anticipated success directly with the original shareholders. The 100% payout for pre-negotiated deals suggests those were likely very promising and close to fruition. The 50% for future deals is a smart split, incentivizing Zeno to develop and market these new assets while still giving Repare's former shareholders a significant stake in that upside. This entire deal can be seen as a validation of Repare's scientific work and its potential to create value, even if it hasn't reached commercialization on its own within a timeline that satisfied its investors. It is a classic biotech acquisition where a larger company with more resources steps in to advance promising research. The risks here, from a shareholder CVR perspective, are largely tied to the future success of Repare's drug candidates. If the partnerships falter or if new products don't get licensed or sold, then the CVRs won't pay out much. However, the base cash component provides immediate value, and the CVRs offer a potentially lucrative upside without requiring shareholders to bear the ongoing development costs and risks themselves. In conclusion, this acquisition by Therapeutics looks like a win for Repare shareholders. They're getting a base cash payout and an opportunity for significant future returns through the CVRs, which are clearly designed to capture the future value of Repare's innovative research programs. It's a strategic move that likely benefits both parties. Repare gets to see its potential fully realized by a bigger player, and Zeno expands its oncology portfolio. Alright? That is our breakdown of Repare Therapeutics' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.